as one of the world's most attractive and stable real estate investment destinations. Whilst international travel restrictions have made deal-making somewhat challenging, it's now estimated that Middle Eastern and Asian buyers represent over 35% of international demand. With a marked increase in deals already visible, pent-up demand is expected to continue through 2022. So without further ado, allow me please to introduce our very experienced panel of speakers. All have been involved in numerous international and UK real estate transactions, and they have considerable experience of working with Middle Eastern and Asian high net worths, family offices, and institutional investors. We have Stuart Jarvis, the investment director at Jade Merchant Bank, Kirsten Muller, managing director, Alvarez & Marsal Tax, Moad Gabali, partner from Trowers and Hamlin, and last but not least, David Carswell, director and head of corporate services, Hawksford, Jersey. A small admin point, if you would like to ask questions, please click on the chat button on the right-hand side of your screen and select all panelists from the drop-down to submit your questions, and we will take the questions at the end. So please let me now hand over to Jade's investment director, Stuart Jarvis, who has the unenviable task of setting out the investment landscape scene. Stuart, over to you.
Hi, good morning, everyone. Thanks to those who've been able to join us. I think I'll start with a quick introduction to Jade Merchant Bank for those of you who don't know us. We were set up a little over 10 years ago. We're based in central London in St James's, but have parentage back in Kuwait. Now, notwithstanding the name Merchant Bank, we specialise in commercial real estate, capital markets, and bespoke family office services. And because of our parentage, we predominantly serve a client base in the Middle East and beyond that, almost specifically into the GCC. Our background as a team is in hedge funds and investment banking. We're quite proud of this. We think it brings a slightly differentiated offering to the real estate investment management market. We're a full service company. That means we start with the origination of assets, take it right through bidding, through the structuring of a transaction, asset managing, and hopefully a successful disposal. I'll take you through the detail of that in a later slide. We pride ourselves on rigorous screening to make sure that opportunities that we bring to you as a client are bespoke and tailored to your particular investment requirements. Over the last couple of years, we transacted about £300 million worth of stock. I think that's testament to the appetite of our investors, and also what the market has shown us as available to acquire over what has been an interesting year and a half or so with COVID. We are authorised and regulated by the UK FCA, which I hope brings extra sort of rigour to the trust you can have in Jade Merchant Bank. A couple of success stories recently. We acquired BAE Systems office campus for 29 million at the end of last year, a transaction we're particularly proud of. It was acquired through an SPV, a special purpose vehicle, and I flag that now because I'm conscious that will come up later in the presentations given by colleagues. We also acquired a Tesco's Extra supermarket for 54 million in the summer of this year. That's a sector that's seen exponential growth in demand, and we're again very pleased to have secured that asset in an otherwise very busy marketplace. Finally, we're working on a portfolio refinance at the moment, where we're advising on a new debt facility for a particular portfolio. And again, hopefully that demonstrates a broad breadth of skills that we bring to the table across acquisition and refinancing. So the origination process, I think it's worth going to some detail on that. We start by seeing anywhere in and around £500 million worth of stock per month. Now that depends a little bit on seasonality. It'll be a little bit quieter over Christmas, sometimes a little bit quieter over the summer. That's broadly what we see each month. And these deals are coming in on-market sales from agents, off-market introductions from property owners, and very much it's part and parcel of us to bring in as many deals as we can. But at that point, we have to shortlist them. So we log all the introductions. We take a very statistical approach to seeing what's coming in terms of the quantum of the deals. Are they the right size? Are they the right yield profile? And every week we're reviewing them together to try and whittle it down. And I would say only about half of those deals make it through. We then go into a more detailed review process. So this is financial modelling, looking at rental tone, looking at the investment market for the particular asset in their particular sector. And after that, we get ourselves down to maybe only £100 million worth of stock. Finally, we take it through our own internal investment management committee. If we still, after rigorous analysis, like that deal, we will then start considering whether it's worth taking it towards a client. But as you can see from the slide there, we're going from 500 million at the start right down to 50 million. So the point we want to emphasize to clients is that really we're not here to just show you any deal that's on the market. There's a very sure and steady methodical sifting process to make sure that the assets that you see from us will match your requirements. Okay. Yeah. So there's a life cycle of the investment that's worth touching on here. Now, the very first step for us is to make sure we fully understand the investment requirement from the underlying client. Very happy to go meet you wherever you are in the world, sit with you and spend time to understand what's your risk appetite, what's your agenda, whether you're a family office or a listed corporate. You will have a very clear investment strategy, and we're here to make sure that we understand it. There's clearly no point in us bringing deals to you that don't fit your requirements. So that's a conversation that has various iterations, but we want to make sure we fully understand where you're trying to go with your investment thesis. After that, as you know, we're going to propose various opportunities to you. Now, that's after the full sifting has been done. Again, it would waste our time and your time to present any old idea. The idea is to try and hit you with ideas that immediately hit the spot in terms of the quantum of the deal, the return profile, the length of holding, the amount of leverage. There's lots of considerations we're trying to glean from the investor to make sure that our presentation to you hits the mark. Now, after that, if you do like the building as an investor, clearly the next stage is to submit a bid. It's worth saying that sadly not every bid will result in you getting under offer, so there does need to be a certain amount of kind of liquidity of offers going out there. You know, if a hit rate is 1 in 3 or 1 in 5 as an investor, you're probably doing quite well. So we will submit the bid on behalf of the investor. We'll draft the offer letter, and at that point we'll take up the initial discussions and try and get under offer on the asset. And the very first step then is to arrange a set of heads of terms, which we will lead on. These heads of terms will set out kind of the building blocks, the parameters of how the deal is going to progress. And the aim is to have a set of heads of terms, which will also be reflected at the very end of the deal. So it's important that the starting point is rigorous and based on a lot of detail. And there we'll certainly pull in advice from our colleagues on the call today. So be it tax, or be it legal, or be it structuring, all of that's brought together at that early stage. Now, the acquisition process will be touched on, I think, by colleagues in other slides. But suffice to say, there is a lot of hard work in there that Jade is very happy to roll up our sleeves and get into. And that means we're working in detail with the lawyers to make sure the legal piece is done correctly, working with the accountants to make sure that if we're buying an SPV, that's rigorously analysed. And obviously we're working with surveyors who are doing the practical kind of analysis of the physical property and any tax work that goes alongside it as well. So there are multiple work streams that Jade is there to manage. As a client, if you want to have 1 email a week as an update, that's fine from our side. If you want to be involved and copied into every single email, that's equally fine. We're here as Jade to make sure that you get as much involvement, or frankly as little involvement in the acquisition process as you're looking for. After that, successful completion of the acquisition, we're then into the asset management phase. Now, typically our investors will hold for around 5 years. Most investors to date have looked for relatively vanilla investments, and that's to say they're looking for 4 rent checks a year, potentially with an uplift in the rent during that time period, but they're quite sure and steady investments. Nonetheless, it's always important from Jade's perspective to make sure that we're reporting to the lender, if there's one, accurately every quarter. We're making sure that the financial model is still being supported by the rent coming in, and we're working with people like a property manager on the ground who are checking the nuts and bolts of the property, checking insurance has been paid, and generally making sure that the whole investment is ticking over successfully. If you're looking for a more value add play, then clearly there's more involved, there'll be more reporting done, and we'll be working harder for you to make sure that either the development is going on time, that the reletting process is going on time, but we're there throughout to kind of hold your hand, if you will, to make sure that everything is going to plan during the investment period. Finally, and equally importantly, is the disposal. This can be an on-market sale. I think in the current market, that's the best way of approaching it, to make sure that maximum bids are coming in, maximum visibility of your opportunity. However, if you would like a discreet exit, we can certainly arrange for an off-market sale where we would approach specific buyers who have specific interest in your asset class. And hopefully after your hold period, you'll then get exactly the return that was sort of foreseen right at the outset, both of the heads of terms and before that. So there's a lot of work that goes on there, but suffice to say, Jade's involved at every single stage. Now, thematic opportunities. This is the reason you've tuned in and where it gets a bit tricky. I've got 4 themes for you to present. Some will be perhaps obvious to you, some less so. I'd like to tell you that each one is a guaranteed get quick rich scheme. Alas, it's not quite the case, but I do think genuinely these 4 themes I'm going to present are aspects that should be a part of your investment process going through 2022. Now, the first is inflation. Clearly, there's a lot of talk in the business press at the moment as what will happen in the UK. The base rate, you can see the graph there, hopefully, is at an all-time low. And I present it to add some context. I think a lot of reporting that goes on at the moment can refer to percentage increases. What I would like to sort of emphasize today is that this is a percentage of a very low base rate. The base rate at the moment is 0.1% from the Bank of England. Likely at the next meeting, they'll increase it. And during the course of next year, it could even hit 1%. But, take a good look at that graph again. If you can see it clearly, we're at an all-time low in terms of the base rate. So I would argue that at the moment, whilst there is some inflation creeping into the market, that's a product of GDP starting to grow and a recovery from COVID. So I would try to reduce any alarm bells that are ringing for you as an investor. I would try to sort of lessen that concern and try and add some context as to where we are. Now, many people say that real estate provides an inflation hedge. Now, that's almost true, but we hit here an issue with correlation versus causation. Now, if GDP is growing, you may then see inflation growing at the same time. But really, as a real estate investor, we should be concentrating on GDP. And that's where we see the fuel of the real estate market coming from. So there's a nice quote here at the bottom. Commercial property prices have a looser relationship with inflation and a much stronger link with economic growth. So as an investor, how do you grapple that? How do you turn that into an opportunity? Well, many leases have a link to RPI, the retail price index. Now, it's worth flagging actually that the RPI is going to be phased out over the next 10 years or so, and you'll start hearing about CPI, the consumer price index. But nonetheless, when you're looking at a lease as part of an investment, do look out for RPI or CPI linked increases. Now, these tend to happen every 5 years, and they tend to compound the increase in inflation of that period of time. Now, to state the obvious, if inflation is starting to run a bit faster than it was, there's an opportunity for extra performance in your lease. So as your rent review occurs, what you'll tend to see is a formula a little like I have on the screen at the moment. So you'll take the RPI figure for, say, October 2021, and then you'll divide that by the RPI figure back in October 2016, and you use that as a multiplier for your current rent. Now, what's quite useful is with RPI, we have a full data set published. So the table below, what we've done is we said, well, if there's a rent review this year, next year, and going forward to 2026, we have the data points to start from. So this isn't sort of wishful thinking and wondering. These are genuine data points we can start from. Then we start to look at the forecasts. Again, we've used the government's, the Office for Budget Responsibilities forecasts they put forward. So we start to get to extrapolate out where rents are going to go. And this is where it gets quite interesting. You can start to program into your investment model the rental uplift you're going to see. So what we've done here is looked at what will the increase in rent be, and I say that's taken from a data point in 2021, for example, in the first line, and then using the forecast. And you can see that if you've got a 5-year rent review in 2021, you should be achieving 17% on your rent, and that's an equivalent to around 3.3% per annum. So if RPI is increasing, there's a chance here to enumerate exactly what that'll be, add in the inflation forecast, and really know in quite granular detail where your rent should be in years to come. And what's interesting is if you look at where investment yields are, so in the acquisition and disposal yields, investors tend to pay a little bit more for RPI tracking leases. There's the option of having an OMR, an open market review, or the option of having a fixed increase through RPI. And it tends to be that investors prefer to have RPI linked leases. So my first opportunity I'm flagging to you when you're acquiring next year is really do look for these RPI linked leases to guarantee the performance in the rental increase, but also to be equally, if not more attractive to the investors coming in. So that's opportunity number one for you. Optimum debt. Now, many people say to us, we want to sweat our equity. It's a very well used phrase. And I often wonder what that means and how can we truly do that for investors? Now, many investors will be leveraged, typically around 50 to 60%. That's where the UK senior lending market tends to get to. The lenders are conservative by nature. They're not in the market to support super tight yields. The reason I say that is that they have a margin to reach as well. Like you as an equity investor, they have a margin to meet as a debt investor. Many of their loans will be fixed to a LIBOR swap rate or a SONIA swap rate going forward. And what that means is that there'll be a base there. Now, I've put a couple of yields in there. SONIA is trading for 3 year, 5 and 7 years at around 0.9%. LIBOR is 3 and 5 year, about 1.1. I've seen this morning that 7 year has drifted slightly. But my point there is that you have, for a lender, you've already got, if you're using a swap, around 1% as a baseline. Then there's a margin on top. So as a result, if you're buying in at a very sharp cap rate, and I'm thinking here, 3%, 3.25%, actually the differential between what you're paying to the bank and what you're receiving is quite thin. So if you look across to the graph on the right hand side, we did a little exercise here and we said to ourselves, well, what asset could we buy for 3.25% net initial yield? And then what debt terms could we get? And as a result, we thought, well, the outcome of that is the uplift in your income, this is pre-tax and pre-cost, so very illustrative, will be around 62%. And we went through each sort of yield profile, and we found that the best place to be receiving equity was around 4.5% net initial through to around 5.75. That's kind of the sweet spot, if you will. It's at that point that lenders are most efficient, most aggressive in terms of the margin that they can give you. What's interesting is once you get to softer yielding assets, and I'm talking here 6% net initial and outwards to 7%, at that point, the real kind of conservative nature of the lender kicks in, and they will probably reduce the loan to value they'll offer you. They may even bring amortization, and they'll also they'll soften the margin. So what could have been 2% becomes 3%, becomes 4%. And so even though you're leveraged in those softer yields, you may be making, say, an 8 or 9% cash on cash return, but actually you're probably already buying it at 6. So the differential there is quite slim. So a couple of examples at the bottom of the slide for you. If you're buying at 4.5 net initial, it could return you almost 8% a year. Now that jump from 4.5 to 8% is, from our numbers, is about 75%. Whereas if you're buying a softer yield, a 6% net initial, the uplift to this 8.8 that we've calculated is only about 47%. So I hope you can see from that, if your mandate is to truly kind of sweat your equity, be aware that a sharper yield, you probably won't achieve it through leverage, and certainly with a softer yield, again, you won't be achieving that maximum sweating of your equity. So we're supporting deals in that mid-range. Our next theme for you are 3 letters which you probably can't avoid it having heard through the course of this year. It's ESG, it's environmental, social, and governance. Now, this is playing an increasing part in real estate, and I think for government-funded entities, for publicly listed entities, this is absolutely top of the agenda. No one wants to fall foul through the press or their shareholders of making any mistakes or not being up to speed on their ESG impact in the world today. Now, what does ESG mean for real estate? I think for the environment, it's quite clear. You've got 2 different phases. You've got the construction phase of your building, and there we're really looking at how environmentally sound are your practices, what are the carbon emissions from constructing your project, and after that, the secondary is the operation of your building. Is your building efficient to run? Historically, we've had BREEAM, which is about construction excellence, and also EPC, which are the environmental certificates, which show how efficient your building is. If we roll on to social, I think we have to remember that every building is part of the built environment, it's part of a community. It's quite hard to govern as a landlord, but you don't want your building to be anything other than a positive addition to the society in which it sits. Governance, again, is more of a corporate level. I think to try and bring it back to real estate, you're looking at how your property manager, potentially I'm thinking of somebody who sits on the front desk of a building, be it office or residential, how are they operating in terms of their governance structures? Is diversity and inclusion at the forefront of their thinking? And similarly, at the top of your company, I imagine that ESG will be part of the agenda as well. So there are three aspects there. But how do we find an opportunity in ESG? Now, notwithstanding it being the right thing to do in any event, there's a real risk here of missing the boat. And I think it could be an expensive boat to miss. We're starting to already see premiums paid by investors and to an extent lenders to make sure that any deal they're doing has very strong ESG credentials. I think if you fall foul of any one of those 3 letters, you may not get the debt terms you're looking for, you may not get the investor interest that you're looking for. And if that's your own money going in at the beginning, think the long term, think of exit. When you come to exit your property, will you have the right credentials and track record there to ensure that you're top of the market in terms of ESG? Now, how do we do that? There are a number of frameworks that are out there. I think they're going to change over time. But 2 that I'm going to flag today, you have neighbours for construction, which is a specific indices which assesses how environmentally sound is your construction process. And GRESB, which is actually, I think it's an Australian formed idea, but it's gone international at the moment, and that's for built assets, and that assesses the kind of the green credentials of your building, and also again the social and governance aspects as well. So they're 2 to flag for now, but I really think as we go forward, this is something to start tracking And when you get to a sales brochure in 5 years' time, I can well imagine there'll be a whole page on the ESG credentials of the particular asset or the portfolio. And what I'm saying to investors now is don't miss the boat. Make sure that you're tracking and have a view on this. If not on the way in, you will certainly need a view on the way out to make sure you're getting the maximum amount of money for your building. And as I said, I think that ESG credentials will start offering a premium to for an exit value. And certainly ESG compliance will be the norm going forward. That's ESG. Next slide, if I may. Michael, are you still there? Oh, there we are. We're on demographics. Demographics plays back to my thoughts on the statistics. Now, there are many moving parts within the real estate industry, but demographics are out there to be to be reviewed on a daily basis. The government publishes this data, and so you can see how many babies are born each year. You can see how many kids are hitting 18 years old and thinking of going to university. You can see how many people are hitting old age, which is described as 65 years. And as I get older, I find that horizon getting increasingly close. But 65 years and above is categorized as old age. And what we can look at is what real estate is available to service that moving kind of demographic requirement. So there's two that I'm going to flag here just for ease of use, but it could be used for any age bracket. So students is a really interesting one. We've just hit an upward curve. We hit the lowest point of 18-year-olds last year, and clearly through birth records, we can track the numbers coming through. So this year, 18-year-olds entering university saw a 7% rise. We now see 37.9% of all 18-year-olds entering university. But we also know how many 18-year-olds are going to come through next year and the year after. And basically, it's exponential. For the next sort of 5 to 10 years, there'll be an increase of 18-year-olds, which interestingly diverges from the rest of Europe as a comparable set. So as an opportunity, my argument there is start looking again at student accommodation. I appreciate it's had its troubles through COVID, as many real estate asset classes have, but if we have an increasing number of students, put quite simply, the supply of privately built student accommodation beds won't be keeping track with that increase in demand. So you have a 5 to 10 year run of a disparity in supply versus demand. So that's one particular kind of demographic that I think is worth flagging next year and for the next couple of years. The other is the elderly sector. This is slightly different. Now, I appreciate for the elderly sector, there's more of a care component. And I think real estate asset owners can get a little bit scared of the implications of care. It's one thing to administer a student block. It's certainly something different to care for the elderly population. But there are three kind of bullet points, three statistics that I draw your attention to. By 2025, 20% of the UK population, and that's 14.3 million people, will be over 65. So you have a very large demographic. Then you sort of unpick that a little bit. The over 65s apparently will have a combined equity of 800 billion of housing, and that is a phenomenal sum of money. And typically these individuals, or the majority, are living alone in their property and they own all equity. But these properties won't be fit for purpose. Once they sort of cross over from 65 to 75, they will need smaller buildings, different style buildings, and increasing care. So what we're flagging here is that the changing demand, changing requirement from this age bracket needs to be catered for. Now, JLL have come out with a statistic here that there'll be a need for 725,000 what they term housing with care units by 2025. Now, to me, that's a very large number of units that are required in a very short space of time. So what I'm trying to flag here is you have another demographic group, which we can prove through statistics that they certainly exist. We know what equity they have in their existing real estate, but we know that that existing real estate isn't really fit for purpose for them for the next 10 or 20 years. So what we're saying there is there's certainly an opportunity to cater to a market that is grossly underserved. And so the key drivers clearly for your accommodation there for elderly people is the location. Is it cost efficient care you're offering? Now, I appreciate through Brexit and other dynamics, trying to find qualified staff to run these premises is tricky. But if you can cross that and you can create a differentiated brand or service offering to what is quite an institutionalized asset class, there is a genuine opportunity there. So not the lowest of hanging fruit, but my overall point is, in an otherwise uncertain world, look for statistics that are true and clear, and that is demographics. Sector opportunities. I think it'd be unfair of me not to go specifically asset class by asset class, but I think time prevents me going through every single one. So I've flagged 4 here to try and give you a flavour of where we're at in the UK market at the moment. So top left is commercial offices. My favourite quote I've heard this year was the death of the office has been greatly exaggerated, which is a bad paraphrase of Mark Twain. Now, what we're seeing is that during COVID, there was very much a death and doom feel about offices. However, there's been a clear push to see people go back to work. And I think companies realize, certainly larger companies realize, that to maintain and grow a corporate culture, to help kind of educate younger members of the team that are joining, you need to be there physically in person. There's a real benefit to communication flows, to collaboration, and even on the other side of the coin, perhaps controlling any potential risks. So companies are bringing people back to the office and really pushing them to do so. And so I think offices will remain, the center point of commercial activity, and the concept that we'll all work remotely, notwithstanding that I'm working from home today, will return and then some. So we've seen financial services are leading the back to the office charge. They're clearly one of the key occupiers in the City of London. So if you look through City of London, Canary Wharf, and into the West End, occupational rates and taking up new leases is actually ticking over quite nicely. There's been no data presented to say there's any particular, drama or disaster unfolding in the occupational sector. But I do think if you're coming in as a purchaser, let's really think about how the building could be devised and divisioned in the future. You're thinking about an office that if a tenant does want to reduce space, can you easily divide it? This comes through how it's configured. So I think the floor plates that can be divided are very important, and take that into consideration. We've seen large call centers, which really were just a shed with a lot of telephone lines going in. Now that's tricky. If that tenant leaves, you have a very large office shed. It couldn't easily be sliced and diced into multiple occupiers. So keep in mind, even if you have one tenant now, what could be the future use? Are you future-proof for any movements in the office market? And also location. It's a cliche of real estate, but is your office in the right location to have mass market appeal? We see opportunities where you have a good tenant, but in a very bizarre location that really, if they left, you simply wouldn't get the draw in against that location. So kind of back to basics. Where's the location of your office, and can it be future-proof by slicing and dicing the layout to have more tenants in or different configurations? But, the yields are holding up very strongly. Southeast offices reported at 5.5%, and city offices at a fairly eye-watering 3 3/4. So there's no distress in that particular marketplace at the moment. Would I say there are opportunities there? Maybe through sentiment. There may be some slightly cheaper offices in core plus type locations, but for core offices, I would pull you away from that. I don't think there's any discount for core offices at the moment. Going down on the page to retail, this is fascinating. To try and keep up the literary trend here, a tale of two cities, I would call it. In the retail sector, on the one side, you have supermarkets, which have become considered almost infrastructure in their nature, and the yields are collapsing every day on those, as in coming inwards. I think with supermarkets, there was a discussion around, or how we provide last mile distribution, and then the supermarkets thought, well, hang on, we've already got it. We've got a premises pretty much in the centre of every town and conurbation, around the UK. And if you're based in the UK, if you're thinking of, say, a Tesco's or a Sainsbury's, the little blue vans that go running around doing your online deliveries, they start their journey at the supermarket. And so supermarkets now are realizing that their supermarket has at least two uses. Fine, you can walk in as a shopper, but it's become its own distribution hub. And you can start to see supermarket yields getting closer to where the logistics market yields are. So supermarkets are certainly flavour of the month, and I think we scrutinise deals that come in there. I think some yields are getting too tight to see an opportunity, but where perhaps there's a touch of over rent or it's a shortening lease, I think there are genuine opportunities there for supermarkets. I don't see many vacant supermarkets occurring anytime soon, and that's on the positive side. Then I think we have to show some realism as to what's happening on the high street in the UK. There's clearly a gear shift, there's clearly a reconfiguration going on, and I don't think retail occupiers truly know yet what they will need to have as a floor plate going forward. I think if I was looking for an opportunity there, it's a high risk reconfiguration play. I think you're taking on buildings in town centres, which may be all retail right now with one occupier, but I think actually you'll start to see a bit of ground floor as retail. There may be some offices above, or maybe residential above, but there's a reconfiguration play there. So if you have quite risky capital you want to deploy and you're looking for a high IRR, I think high street retail presents an opportunity, but it's certainly not a vanilla income play. This is more the value add play and really sort of rolling your sleeves up and seeing what you can do with a specialist local kind of developer to reconfigure the high street, which is certainly an unknown quantum at the moment, but there are some returns to be made there. Yield guide for you, high street retail, clearly 6.75, showing that the risk attached to that. Retail warehouses, 5.75. So these are the big boxes that you see out of town, let to people like Pets at Home and Halfords. And then food stores, as I was just saying, those based on open market reviews are at 4.5. And I think, as I mentioned earlier on about RPI linked leases, your 4.5 could easily become 4 quite quickly. So that's the retail sector with sort of two very distinct sides. Logistics is fascinating. The yields compressed on that probably over 5 years ago and really have not come back. The issue with the logistics sector is getting planning is difficult. And even when you get planning, is that site specific enough for a particular company? Now, in the current environment, supply chain seems to be hitting the business news an awful lot. And the issue is it's gone from being almost like a back office function to being front and center of part of the strategy. The idea of being just in time and just enough in terms of being efficient no longer works. Companies are looking for extra capacity, extra storage to make sure the resilience is built in. You know, a famous story in the UK recently was a lack of truck drivers. And so getting their stock to market was proving very difficult. So supply chain is front and center. So the lack of supply of these buildings and the ferocious uptake in demand from occupiers means that rents are going up and then yields are going down. So incredibly there, yield guide, open market reviews, 3.25% for logistics, which tracks back to my lending slide. If you're buying at that level and you're adding debt, you're really not sweating your capital very much. But if you have a strategic understanding and you want to be in logistics, then I think you are rock solid, but you're rock solid with a relatively low return. Finally, to flip it completely on its head, let's look at alternatives. Now that will play back to the demographics that I spoke about. So, you know, old age care and student accommodation. Other alternatives to look out. In vogue in the moment are science parks. So those are innovation centres, those have links to universities. I think because of the coronavirus and the focus on developing vaccines, it's really brought these into sort of focal point. I would argue with science parks that are doing very specific research work, you kind of have an occupational risk. Whilst your occupier is there, they have very technical kit in there. Maybe a reason that they won't leave, but if they did leave, what have you got left? If you're on the outside of a provincial town, albeit with a good university, what's your other occupier? So I'm a bit wary about people who get overexcited about research centres. I think slightly a one-trick pony. If a tenant leaves, I think you're left with quite a niche building in a niche location. My second bullet point there is about healthcare, senior housing. We've touched on that. I think there are opportunities there in the right location. I think demographics support it. And within that, I think similarly, single family BTR, build to rent. There's a kind of a gear shift going on in the UK at the moment where we find potential homeowners can't quite afford the deposit or the leverage on their mortgage. So they're renting for longer and longer. And I think investors are starting to realize that, developers are realizing that. So there's a burgeoning market now for build to rent. And that's really interesting. There's going from being a niche asset class and it's really quite quickly tracking to become more of a core offering and seeing investment funds piling in. A couple more ideas to put on your radar. Data centers are fascinating. It's very hard to get the power connections into a data center and the cabling brought in. So once you've done that, that becomes a very valuable asset. Look, we like data centers. Yields are coming in on that. The difficulty with that market is there's very few to actually go and buy that are coming through. And finally, renewables. I think that the ESG agenda is really bringing renewable energy to the fore and forestry to the fore. So a bit of a curveball to end on, but I would argue that if you start investing in these sectors, the trend, the movement behind ESG means that the value of forestry, of renewables in the future will start to really, will drive forward. And it's also quite a good little mitigation. If you have an inefficient building in your portfolio, you're concerned about ESG, but if you buy renewables, forestry, you start to balance out your impact. So I think there is a market to be had. I think there's profit to be had in renewables and forestry going forward. So that was a pretty whistle-stop tour of themes and sectors. Hopefully you can supply a few questions on the chat function, or by all means contact us at Jade offline after the event. But look, I hope that's a useful introduction to some themes and opportunities for 2022.
Right, thanks, Stuart. It's really interesting because a lot of what you mentioned there is something we're seeing our clients doing as well. In particular around student accommodation, that seems to have a strong revival, and the same supermarkets. Obviously, we're working together on a transaction but also with a number of our other clients. So just as a brief intro, so my name is Muller. I'm a managing director and I'm responsible for real estate at Alvarez & Marsal. So our firm is an advisory firm that serves a range of financial investors, corporates and funds. And the firm was really founded in the principles of providing high quality service to our clients, particular practical advice, and ensuring that our clients can achieve their business investment objectives. So we've got colleagues all across the world, and the majority of our work is international, be that working with investors based in the Middle East, Far East, or elsewhere, and assets across the UK, Europe, and beyond that. And really, for those investors, we provide a range of services from financial and tax services. I'll talk about tax this morning. And we work collaboratively with other advisors on a transaction, real estate transaction. So be that Jade, Muller from Travers, or David from Hawksford, as we've got this morning. In terms of what we're going to talk about this morning, and Michael, if you could go on the first slide, please. Really around the main tax consideration of a property life cycle, so ranging from acquisition to the hold period and exit. And I'll be talking about the sort of transaction taxes at the outset when you go and buy an asset, the deal structure, a bit about the acquisition process, any sort of taxes you have to bear in mind when you hold the assets to then exit taxation, and the way that people may wish to sell the assets. If you go to the next slide, please. So on acquisition, there are two main ways that people acquire assets in the UK that I think are relevant for this discussion. One is an acquisition of an asset, as you buy the property directly, either with freehold or long leasehold, and the other one would be the acquisition of a company or vehicle that owns the asset. And the principal tax impact of that will be around the transaction tax or stamp duty land tax that's payable. So when there are different rates for residential property and commercial property, and frankly, those rates have become increasingly complex over the last few years as the UK government's realised that real estate and UK property is an asset class that people like to invest into. So they have gradually increased rates. So the rates for non-residential property, commercial property in particular, so offices, hotels, retail, care homes as well. So effectively, these are properties that aren't suitable to be lived in on a permanent basis. We've got them on there, and they effectively go from 0 to 5%. So 5% would be your maximum rate of stamp duty land tax that's payable on the acquisition of a commercial property. Now compare that with the stamp duty that's payable when you buy a company that owns the property. If it's a UK company, it's 0.5%, and it's 0.5% of the value of the shares, not the value of the property. So that typically is a big difference. It's obviously much more than 4.5%. If you buy a non-UK company, and we'll talk about that in a second, then there's 0% UK stamp duty payable. So unsurprisingly, a large number of the transactions we are seeing are the acquisitions of non-UK companies owning UK real estate. And that is indeed a very popular way of owning UK real estate, principally for that reason. There's some other ones. Just briefly, for residential property, the rates range from 0% at the low end to 12% at the high end. There is a 3% surcharge, so that would make it 15% for second or additional residential properties that people own, and that is a worldwide classification. And then just recently, this year, there was a 2% surcharge announced for non-UK residents buying residential property. So potentially, the SDLT payable on a residential property can be 15% and beyond. And also companies buying residential property have to pay 15% stamp duty land tax on anything over 500,000. So if we move on to the next slide, please. So I talked a bit about the difference in stamp duty that's payable on an asset purchase versus a share purchase. And I think that is the key difference at the outset. and obviously that can be for commercial property, say commercial property of 50 million. If you buy it as an asset, that's stamp duty payable of £2.5 million. If you buy it in a non-UK company, there's zero. So it's a big difference. In terms of other taxes to consider, so from a VAT perspective, typically the properties we see investors buying will be let. And obviously what Stuart has talked about is principally let properties. As such, there shouldn't be any VAT payable as long as the transaction is structured correctly. And of course, if you buy a company, there's no VAT payable either. There is a bit of a difference in terms of your tax base cost, which is reset to the purchase price when you buy an asset. Whilst if you buy the shares, you inherit the seller's financial and tax history. A share purchase is typically a more complex purchase process, and I know Moab will cover some of those aspects afterwards in terms of some of the legals. Certainly, it's a process that requires diligence, which I'll be talking about in a minute. But of course, the big benefit there is, in my example of a £50 million purchase, it's the 2.5% stamp duty is not payable. So we move on to the next slide, please. I've just set out briefly the key differences between the process between asset purchase and then a share purchase, and really highlighting the fact that a share purchase has got some additional steps. Certainly, financial diligence is something we recommend, and the majority of our clients will require. Financial and tax diligence are also key components if you're looking to get insurance on a share purchase. It's insurance for the warranties and indemnities that are being provided. Certainly on real estate transactions, warranty indemnity insurance tends to be a feature of the vast majority of the transaction we're seeing, and I think that's quite representative of the market. If you move on to the next slide, please. So what does a typical transaction structure look like? So typically we'll have the investor, called parent. So it might be a trust, it might be an offshore company that seeks to buy a property. As I've mentioned, common jurisdictions for holding these companies will be non-UK, and the ones we see most often are the Channel Islands, the Jersey or Guernsey. And I know David will talk a bit about choice of jurisdiction later. We also see Luxembourg for certain types of investors, in particular investors from Europe. But there may also be existing structures set up in Luxembourg, and we see BVI, British Virgin Islands. And in terms of factors to consider when setting up these structures is what is already available. So if you're buying a corporate vehicle that owns the UK property, they may already have a structure set up. So that might be Channel Islands, it might be Luxembourg. Also, what is your strategy? If your strategy is one of generating rental income and capital growth, then an offshore company absolutely still provides some benefit. If it's one of developing the property, then there is a question mark as to whether a UK company may actually be better, because it is undoubtedly easier to conclude contracts with a UK company than there is another company. Now, one that's increasingly mentioned by my clients is the ease of doing business. There is quite a marked difference between, in particular, Luxembourg and the Channel Islands, and that certainly my clients seem to prefer the Channel Islands for the ease of doing business. The law is much more based on English law. It's generally the infrastructure that's there seems to be much more set up, in particular for sort of mid-market type transactions. Also, ongoing costs need to be considered, in particular around the complexity of the structure. So in my example here, I've got a property company that is obviously set up, say, in the Channel Islands that owns the property, a holding company. A holding company isn't necessarily required, but certainly if you're in multiple properties, it's something worth considering. Of course, the other thing then, which I'll be talking about in a minute, is around taxes on disposal and how profits are repatriated from the property company back up to the investors. We can go to the next slide, please. So I don't intend to go through all of these in details, but in terms of the ongoing compliance, for the last 2 years now, the tax systems for non-UK owners of UK property and UK owners have been aligned, so that it's now corporation tax for all of them, which has meant an increase in the compliance, tax compliance obligations for non-UK owners. So I've said those out, and you know, we can go through some of them. I mean, I think key ones that to note is that the tax payment dates are now slightly earlier than they were before. Tax rates have been aligned, so they're currently 19%. There is obviously a government proposal to increase tax rates from April 2023 to 25%. I think it remains to be seen to what extent that actually goes through. I think the other point to note is around any losses that can be relieved going forward. So there are now some additional restrictions, but also some opportunities around utilising the losses between different investment companies that you may have. If you go to the next slide, please. So the other thing that's really important to consider, in addition to ongoing taxation, is around how profits or how cash is repatriated from the property company back up to the fund or the investors. I'll have an example where we pull all this together later, but key points are, I mean, the 3 areas where profits can be repatriated are through the payment of interest on shareholder loans, and for that we have to consider withholding tax. So the UK does levy withholding tax at 20% on interest that is paid out to non-UK jurisdictions. Now that withholding tax can often be mitigated down to 0%, either by structuring the loan correctly or utilising a double tax treaty between the UK and the investor jurisdiction. So typically, in all the structuring that we do, that withholding tax would be reduced to 0 or near 0. So typically that is a good way of repatriating cash. Of course, profits can also be repaid by way of dividends, either from the UK or non-UK company. There is no withholding tax on the payment of dividends from UK companies or Jersey companies. The only thing to bear in mind is that a UK company has some corporate law restrictions on the amount of dividends it can pay. And in a real estate scenario in particular, that can be a bit more challenging. For instance, if there's been an impairment in the asset value, a UK company cannot easily pay dividends. Now, interestingly enough, a Jersey company can do so. So there, it's more about the cash that's available. So that's one of the reasons why a lot of our clients tend to prefer using Channel Islands companies. The third way to do it, and it's got some limitations on, but I think it's worth mentioning, is around the payment of management fees. So if shareholders or investors actually provide some services, maybe if the family office provides some services to the UK property company, then of course they can and should be paid for, and that is a way of repatriating funds. So Michael, if you move on the next slide, please. So before we go into the example, I just want to highlight that since April 2019, UK and non-UK investors are subject to corporation tax on the disposal of UK property, and it applies both to direct and indirect disposals. So effectively, the profit is taxable at 19% at present. The benefit that non-UK investors have, so this applies to Jersey companies, Luxembourg companies, other non-UK companies, is that they have a rebasing of their tax base cost to April 2019. So effectively, only the gain since April 2019 should be taxable. So you have a choice when you dispose whether to use the original purchase price or the value at April 2019. Now, this is still important now, even if you don't own a property just yet, because you may buy a company and that April 2019 value is important to establish what the base cost of the property in that company is. So from that perspective, we continue to see that as an important point, certainly from when we look at investors buying companies. We move on to the next slide, please. I've put together just an example what we've got in terms of an overseas investor. That's actually quite a recent scenario where we've dealt with an investor from China, but it's equally applicable to overseas investors from elsewhere. So they bought a couple of UK assets. One of them was actually an asset purchase, and the other one was a company purchase. So they were from different sellers. But we combined them under a holding company in Jersey. So that's the reason why there is a holding company in Jersey. So for the first asset, purchase one, in my example, we set up a Jersey company, a property company, and that company acquired the asset. So there's no income tax in Jersey, so it's 0%. But we did, of course, have to pay SDLT at 5% of the purchase price of the company. For the second purchase, purchase two, our client bought the Jersey company, so there was no stamp duty payable at all. But of course, the work involved in purchase two was a lot more significant. So we carried out financial diligence and tax due diligence, and worked together with the lawyers on the sale and purchase agreement to ensure that accurately reflected the risks we identified in the purchase of that company. Both the companies were funded with a mix of equity from the shareholders, a bank loan from an external bank, and then also a shareholder loan. So the shareholder loan was effectively money that came down as equity into the holding company and then flowed down as shareholder loan. And the benefit was twofold of the shareholder loan. We were able to extract interest. So we were able to extract interest on an ongoing basis and therefore repatriate cash to the investors. And we're also able to claim tax relief for a part of the interest on the shareholder loan. So we optimized the UK tax position because the interest receipts in Jersey is not taxed. So we achieved tax deduction in the UK, but no taxation in Jersey. Of course, the net rental profits were still taxed at 19%. And we also have the benefit, one of the companies actually has some losses, so we're able to use those losses in the other one. On a future disposal, of course, the investor will have to pay tax, and this is where there will be a difference in that for purchase two, we inherited the historic base cost of the property, whilst for purchase one, our base cost, and therefore our reference point for the disposal is the price that the investor paid for those assets. So that was a sort of quick tour around the sort of key taxation points for UK properties, and I'll now hand over to Moat to talk about some of the legal points. I think Moat, you're currently on mute.
There we go. Thank you, Kirsten. That was very interesting. So I'm Moat Gabali. I'm a corporate partner at Trowers and Hamlins. We are an international law firm based in the UK with 4 offices in the UK and offices across the Gulf. Our newest office is in Malaysia, and we've been advising in the Middle East since 1980. We are a top 10 real estate firm in the UK with very significant expertise on property. So next slide, please, Michael. So generally, Kirsten's touched upon the 2 ways of acquiring assets in the UK. So you have the asset acquisition, which is buying the property by itself, or you can buy the corporate entity which owns the assets incorporated either in the UK or another jurisdiction. If you opt to just buy the asset, the process is much simpler. However, as Kirsten mentioned, there will be a SDLT charge on that asset, which may be significant depending on the value. For investors who want to acquire the target company may be based offshore. Typically, in our experience, either BVI, Caymans, or more commonly Jersey, which are the most common ones. Offshore advisors will need to be appointed as well as your UK advisors, which will increase costs. Due diligence will also have to be undertaken in respect of all aspects of the company. So not just the property due diligence, we have to look at the corporate due diligence, tax due diligence, financial due diligence, and looking at all aspects of the company. And the risk there is also you will be taking on all the liabilities in the target company if you go down the corporate route. There is also a greater number of transaction documents that will need to be negotiated with the seller side if you buy a target company. A word of warning: there's a significant time negotiating the warranties and indemnities, and that does increase costs. It is common for sellers, in our experience, to market assets to potential buyers with their liability capped at £1, and ask for the buyers to take out warranty and indemnity insurance, which sellers may contribute towards the premium as a quid pro quo for liability being capped at £1. Insurer will want to see that due diligence has been taken out and that a set of warranties has been negotiated, so it doesn't alleviate the requirements to carry out due diligence and investigate the company and negotiate a full set of warranties. As you've heard from Kirsten, there's no stamp duty payable if the company is based offshore. There's a 0.5% stamp duty payable if you're acquiring a UK company. This is, however, a significant saving on SDLT, and it is quite common that the SDLT saving is shared between the buyer and seller. If there are concerns about the liabilities in the target company, there is the potential for the asset to be hived across or transferred to another group company, and then the target company can then be either liquidated immediately or, depending on the requirements of the offshore jurisdiction, it may need to remain dormant for a period before being liquidated. The downside is, as compared to asset acquisitions, you've got more advisors, there's more extensive due diligence, but the SDLT saving may be significant, and that will outweigh the increased cost and timeline. Next slide, please, Michael. I'm conscious of time, so I'll go on to the next slide, Michael, and then the following slide. We've touched on those things. So the key documents that you'll be working on an acquisition will be the sale and purchase agreement, the tax covenant, disclosure letter. So I've set out there just the overview of the transaction life cycle. At the very early stages, you'll be negotiating the heads of terms. Heads will include the key consideration and key commercial terms, the timing, conditions to completion, whether, as I mentioned, whether W&I insurance, warranties, indemnity insurance is contemplated, and then whether the seller's liability is capped at £1. The heads will also set out the proposed timeline and the provision of information. Now, you also want some, as a seller, you'd want to ensure that the buyer is tied up and there's confidential provisions, and as a buyer, you'd want to negotiate a period of exclusivity, which may or may not, depending on the asset, may or may not be granted. Once the heads are signed, there is typically you go into due diligence. So we, as a buyer's advisors, we send across our questions, and those would be responded to by the seller. And together with those documents, with the due diligence, you'll also start the negotiation of the share purchase agreement, the tax covenant, and start the negotiations putting in place the W&I insurance. The disclosure letter is a letter from the sellers setting out disclosures against the warranties, and these will all be negotiated together at the same time. What I would say on where you're acquiring a corporate vehicle, you'll have a number of advisors advising. So there'll be advisors in the offshore jurisdiction. There'll be lawyers in the UK. You'll have your accountants. You'll have, if you have a lender involved, there'll be the lender solicitors. So there's an element of project management, which does require a team that works together and is able to, has worked in these transactions before, to work quite closely together. Next slide, please, Michael. So in terms of what can you do to stay ahead of yourself, of the market as a buyer? So are you ready? The assets, there are certain assets that come on the market, and Stuart has touched on it, which will be desirable assets. You have to move very quickly, and ahead of bidding for the asset, it would be good to have your professional team ready and appointed. They're all have carried out their anti-money laundering checks. They have you set up as clients. So this will be your UK solicitors, your lawyers working in the offshore jurisdiction, your financial advisors, your tax advisors, your accountants, and your corporate service providers. Do you have your acquisition vehicle set up? This will generally be driven by tax, but the non-tax considerations are what time zone it's in. It's the offshore companies based in Jersey are on the same timeline as the UK, so it makes transactions a lot easier. The regulation, whether it's how regulated it is, thinking ahead to an exit and what the buyer may want in the future, and also access to advisors. There are, in our experience, Jersey has a range of advisors available who are accustomed to working on these kind of transactions. The other point there is funding. Have a think about funding. Do you have available funding? Are you going to fund the acquisition using cash or debt finance? Have you had discussions with potential lenders? This all takes time, and you want to be ready and be ahead of the curve. Next slide, please, Michael. So on the other side, as a seller, are you ready for a sell? If you're thinking of selling an asset, again, have your advisors set up and briefed on the sale. You can prepare a title pack and up-to-date searches and replies to inquiries to preempt the questions from the buyer solicitors. Establish a data room. Appoint someone to help with uploading information in the data room, so the data room is ready to go when you press the button. And in advance, if there are any problems, do anticipate them. Try and resolve those problems before you start the process. Otherwise, you may get a reduction in price or an indemnity put into the transaction documents. So that was a brief overview from my side. I'll move over to David.
That's great. Thanks very much, Moad. I'm also very conscious of time, so what I'll try to do is really fly through what I was going to say so that we have time to get to the Q&A at the end. For those of you who don't already know me, my name's David Carswell. I head up corporate services team at Hawksford here in Jersey. We have real in-depth experience in real estate. The team here includes surveyors, lawyers, accountants, and a team of qualified administrators. We look after a variety of UK real estate structures for clients, particularly those in the Middle East. We really like to partner up with those clients. We travel to the region regularly. I've just returned 2 weeks ago from a week-long trip with a colleague. We also have colleagues in the UK who can visit the UK assets, whether that's in London or when we're talking about diversifying real estate assets in the UK, quite often these days further afield. Kirsten and Moad have spoken about the attraction of Jersey. So really, I will just reinforce what they've said. Its robust legal regulatory framework, in-depth experience in the real estate sector, stability, proximity, familiarity with the UK market, as well as the same time zone as Moad has already mentioned. Jersey, in particular for Middle East investors, is also able to support Sharia compliant structuring. and Jersey's laws, regulations have actually been written in particular with international investors in mind. Last month, when I was in the region, there was a Jersey finance event in Dubai, where it was announced that Jersey has actually signed its bilateral investment treaty with the UAE, which is obviously aimed to further enhance the relationship between the two areas and increase the investment flow. Stuart has explained the opportunities that Jade see in the UK market. Kirsten Moad has spoken about the tax and the legal side of things. So I'll just quickly run through what we do at Hawksford. Our role is essentially to implement the advice that you receive from your advisors based on the UK assets that Jade will have earmarked for you. We work with the advisors to keep things in good order throughout the life cycle of the investment. So that means we establish the vehicles, we help with the filings, administer bank accounts, we can liaise with property managers, property advisors, ensuring that income flows are received, distributions made to you in line with financial projections. As I say, we implement the advice that you receive from Kirsten and Moad, and really try to make sure that you find the value that Jade have seen in the market for you. Regarding the specific services we offer, as I say, we partner with our clients, and so it's bespoke services for each client. We incorporate vehicles, we can then sit on the board or not sit on the board of directors, financial reporting, Sharia compliant administering, help with financing and refinancing. We obviously know that Middle East clients, like all clients, expect a high level of service, but we're very conscious that we must always deliver that efficiently and cost-effective way. Long track record with clients, in particular in the Middle East. We have high net worth families and businesses that have been clients for decades. I'll also just talk a little bit about, I know Stuart has spoken about the opportunities, but I'll talk a little bit about what some of our clients have been doing over the last couple of years, in particular since the pandemic has hit. A lot of the clients have diversified their UK assets in terms of what they've been looking for. Lockdowns, internet shopping, working from home have sometimes meant that retail and certain types of office space have been challenging. There are opportunities in the market, as Stuart has spoken about, term often used collectively for the opportunities, beds, sheds and meds, which people will be familiar with, I'm sure. I've also mentioned, as Stuart has mentioned, that the opportunities are not just in London. We have seen increasing levels of investment in the regions as well. Student accommodation, as we've heard about quite a bit on talk already. We have student accommodation in regions outside of London, Liverpool, Nottingham, typical university cities. We also have life sciences in Glasgow, logistics, pretty much everywhere in the UK where it appears value can be found. So I suppose really on top of those opportunities, change of use is what we've seen, which is also something that Stuart spoke about. We've seen in occasions office moving to office and retail or office and residential, or indeed other combinations. There's still a market for office space, of course. We have seen some clients upgrade to the higher end and prime market. In short, on top of the opportunities, the new opportunities that Stuart has been speaking about, we've seen a lot of our clients adapting and looking at other options outside of traditionally what may have been the UK market. I'll also just talk very quickly about the broader services that we offer to, in particular, Middle East clients, where we can help, as well as just looking after the asset holding vehicles. We can assist with family governance and succession, as well as the asset holding vehicles themselves. We look after lots of wealth structuring, which can include trusts, whether those be discretionary, reserve powers, private trust companies and foundations, and all of these structures, Sharia compliant or traditional. So just really, as I say, very quickly from my side, to summarise, role at Hawksford is that we implement the advice you receive from the advisors, so Kirsten and Moad. We look after the structures, make sure that things run smoothly. We can tailor our services specific to the client requirements. We would be very happy to discuss ideas, opportunities with anybody. As I say, we travel to the region regularly, and whilst monitoring the situation at the moment, are currently looking at Q1 plans, but very happy to jump on a video call with anybody, visit in the Middle East, in the region, or in London or further afield in the UK.
David, thank you very much for that. That's been a fascinating romp through, I think, 4 different sort of service providers, and I hope that all attendees have found it very useful. I'm very conscious of the time here. I think we've run over by about 20 minutes. I can't see any questions have been submitted, but on the screen in front of you, you'll see the contact details for every single panelist here. So Kirsten, Stuart, Moad and David. If you do have any questions, please absolutely feel free to reach out to them by email, and they will each revert to you individually. Of course, it remains to be said that we're delighted that you joined us today. We hope you found it very useful, and we look forward to hopefully some follow-up conversations with some of you. And if not, I hope that we will be able to put on another one of these informative webinars in the not too near distant future. Thank you very much for your time. Thank you.